This is the third quarter update for the Amplify Seymour Cannabis ETF, symbol CNBS. Tim Seymour, portfolio manager, joins me to break down the third quarter. Tim, thanks for coming back on.
Great to be here, Jay. How are you?
All right. So, Tim, for new viewers, what is the overall investment thesis for CNBS?
Let's talk about CNBS. First of all, this is an active ETF strategy which endeavors to give investors thematic but alpha generating exposure to the cannabis industry, which is a relatively nascent industry growing very fast with a lot of both regulatory and frankly bottom up evolving dynamics. This fund is intended to give investors exposure to those investments that make sense for this industry today as it exists now, and with an eye on tomorrow, where we think we're going to be, and the subsectors within cannabis that are as seemingly intricate and complex and as exciting as the big picture about cannabis, which is this, like, as I say, it's a generational investment opportunity. You have an industry that's growing anywhere from 40 to 60% a year. You have the end of prohibition. And at some point, we believe the size of this addressable market in the United States will be bigger than the entire alcohol industry. So I mean beer, wine, and spirits, but we'll talk about that.
Wow. All right. So let's talk a little bit about the subsectors, but through the lens of your current portfolio positioning. So what are the subsectors that you're paying attention to today?
Well, and it's important. So my lens is that as a portfolio manager, someone that's comes at this as an emerging markets background guy. So I think about cannabis as a generalist. And much in the way when I was investing in EM and running a long short hedge fund, the same approach goes here. What are the subsectors to get exposure in cannabis? People know this is on some level a cultivation and an agricultural story, but really it's a very sophisticated and we think evolving consumer packaged goods or CPG story. And so with that, whether you're Nike or whether you're General Mills or whether you're Coca-Cola, think about the brands that are there, and think about ultimately then the new world order and how Nike is selling direct to consumer. And the same thing is going on in cannabis. So as I think about investing, and I'm a guy that's been in the cannabis industry from the early years. This is sixth or seventh year of focus on cannabis investing. And that's part of understanding where we've already seen such monumental change in the last few years. I think we're going to see more of that again. But who is the Coca-Cola of cannabis? Who is the Nike of the consumer products? And on some level, where you've really got brands that are as carved out and as well established as they are, because they're seen as innovators. They're seen as consumer friendly. So we are trying to get exposure to those companies that are creating tomorrow's brands. We are trying also, though, to find the companies that are the best operators today. And that means they're good at cultivation. They're good at growing. They're good at their operations. And some of these companies, in the way the legislative and the regulatory framework is set up in cannabis, many of these companies have to do a little bit of all of that. They are vertically integrated companies. So in some sense, they are growing, they are distributing, they are a wholesaler, but they're also a retailer. And in some sense, they then are looking for how they can attract and engage and maintain a customer base. And so loyalty programs and technology and apps and interactivity. So we're trying to find all that. And those subsectors are the places that I think cannabis is exposed. There are a lot of people that think about cannabis as a medical market as opposed to just a recreational or an adult market. I think adult market's a better term. So yes, we're investing in the companies who are delivering what we think is a wellness, a medical solution to any one of 4 or 5 pretty common OTC maladies that people walk into your Walgreens or your Rite Aid for. That's part of the exposure to cannabis. Then I think there are the picks and the shovels. So it could be the retailers that are actually the hydroponic stores that are really cannabis specialty retail, companies that are focused on B2B, but again are not necessarily touching the plant. So when you're investing in cannabis and in CNBS, our goal is to have a little sliver or a major concentration proportionate to where we think the opportunity is in this industry. The way the portfolio is today is we think we've got a balance of some of these big integrated companies that are the best operators, and again, companies that are generating free cash flow and are profitable, different than where the industry was a couple of years ago. And then a selection of what we think are those picks and shovels plays. Either way, the portfolio is intended to be 80% or more of the portfolio has to be companies that are deriving more than 50% of their revenues from cannabis. And unlike other cannabis ETFs out there, where there's a lot of exposure to tobacco and alcohol and companies that might be in this industry someday, our mandate is to be a cannabis pure active strategy where we are truly finding companies that are in this industry now with an eye on also the ones that are going to be major players tomorrow.
Tim, as you look back on the third quarter, what holdings stood out to you? And could you give us a couple of names that led you to believe that the industry really is starting to mature?
Sure. So, look, the top of our balance sheet is a mix of a little bit of brick and mortar, or I should say a little bit of kind of ancillary and non-plant touching. There's a company called Weed Maps, which is essentially a two-way marketplace. It is, maybe the Yelp or the DoorDash of cannabis. It's a company that is listed on the NASDAQ and therefore can attract broader capital and investors as opposed to some of those companies that are plant touching and are still restricted from U.S. listings, and therefore we have to own them via a Canadian listing, or actually in some form we own them in swap. But so there's a Weed Maps, there's a Tilray, which is a Canadian LP and the largest and most profitable player in Canada. The U.S. cannabis market is where, though, we are really excited and where I think we have a very significant core exposure. And at the top of the balance sheet, again, there are companies like GTI or Green Thumb Industries, Curaleaf, which is in 23 states and is the largest cannabis company in terms of their exposure, but also their revenue line. Cresco Labs, which is another one of these multi-state operators in the United States, where we think their exposure also to significant part of the wholesaling chain puts them also in a really interesting position to be someone that's evolving with brands. Trulieve is originally the dominant player in one of the most important states in cannabis in Florida, who actually in the last week just closed a transaction that they brought 5 months ago, so slightly before the third quarter, with a company called Harvest. And this is the largest M&A transaction in the space, and one that puts Trulieve in a position where not only are they dominant in Florida, but they have very strong positioning across 11 states now. And so as I think about the balance sheet and I think about the third quarter, the themes that are there really for all of these companies, but first talking about call them the vertically integrated companies. So the companies that are cultivating, they are processing, they are wholesaling, and they also have their retail dispensary footprint. It really was a story of increased profitability. Third quarter sequential growth in the industry was anywhere from 15 to 25% sequentially. So again, if you think about that on an annualized basis, these are companies that, as we look back and when we look back on 2021, a company like GTI will have effectively doubled their revenue base in this calendar year. The EBITDA or the profitability of again, these core folks we're talking about, but I'll talk about it for the sector overall. 2021 will be looked at as the year that the industry not only became profitable, but the 2.5 times EBITDA growth that we saw across the industry. I think specifically at a GTI or a Curaleaf or a Cresco Labs. Very excited about that. So the themes that are most important for investors to know is that we're spending every day setting up company meetings, meeting with companies, going over research, evaluating who now on a relative basis is actually operating at a better margin, who is able to actually increase their footprint. Every day there are new states coming online. Not every day, but the point being, as the expression goes, it's evolving quickly. And so we're going to talk about federal legislation in a second, I know. But what's exciting for the companies I mentioned is that they actually are starting to see an evolution of that growing landscape. And so we have a case here, sorry for the phone, but the cannabis industry never sleeps. And I'm sure that's someone with some exciting discussion to continue to take part in. When I think about where the third quarter evolved the businesses for a handful of these players, you had new licenses being given out in Georgia, which is, as we might imagine, going to be a very exciting, important state. We had Virginia continue to evolve, again, a relatively new market for cannabis. GTI, very well positioned. I talked about where Trulieve and Harvest did this very, call this a groundbreaking M&A transaction. But meanwhile, Trulieve was already hard at work building out their presence in Pennsylvania, which is considered to be one of the most profitable markets in cannabis. So as I look back on the third quarter, really it was an extension of the trends that were exciting trends for 2021 so far. And we'll talk about the fourth quarter, but it really was steady as she goes. Fundamentals actually got better, and unfortunately for investors from a valuation perspective, the industry continued to actually run into pricing headwinds, and I mean performance headwinds, because actually pricing in the underlying products, I think, has been somewhat sideways and consistent. People worry about that in cannabis. They worry at some point when there's so much cultivation coming online, what does that mean for pricing? But right now, pricing has actually been quite stable. But we're talking about performance of the stocks. And September, as a month, saw the major kind of U.S. multi-state operators down 2 or 3%. In Canada, they were down about 15%. And on the third quarter, as you look at the 3-month trends, the industry was down anywhere from 20 to 30%. And now 40 to 55% off the highs it struck in February, when everyone was so juiced up about the legislative path. And the final investment theme for the third quarter to talk about is that as great as the bottom-up fundamentals are, and where we think they are going, and the profitability, et cetera, there was a larger disconnect between valuations and fundamentals. And in the third quarter, a lot of that was due to disappointment on the pace of federal reform. As much as I believe profitable companies generating free cash flow that are strategically looking at their business every day and how they can grow are, put your heads down and invest, and it will take care of itself. This is still an inefficient market, and fundamentals are not matching up to the bottom-up story. The valuation story is closely and I think overly following the macro story. We need macro catalysts, and that was part of the price performance for the industry in terms of the stocks themselves. It was a disappointing quarter, and look, that should give investors a lot of reason for excitement going forward, because the fundamentals are better. The federal backdrop, I believe, will take care of itself. I talked about how it's state by state, the market continues to grow, and that's really the investment. It's one of the big investment opportunities out there. This is an industry that is improving by day, yet there's still a wall of capital that is yet to come into the industry because of federal restrictions. And so investors that are investing in CNBS, we believe, are really ahead of that wall of capital.
So, Tim, as we sit here at the beginning of the fourth quarter, how should investors look at the cannabis market as far as it is an investment opportunity for new capital?
So the fourth quarter, as we said, will continue the themes that are well established on profitability trends, growing top line, increased footprint, growing addressable market. I think there will be a lot more M&A, and I think M&A and different types of capital markets dynamics will be catalysts to a handful of companies. I think you will see more consolidation. I think some of the more established players, the ones that I mentioned that are in core pieces of our portfolio, are going to continue to be very tactical and strategic in terms of how they grow. and the bad news around the slower pace of maybe having this industry get access to federal capital markets and all the things that we'd like to see happen in terms of those headlines. The good news, though, for the legacy players is they further establish and entrench and have a head start on all these other massive consumer products companies like the ones I mentioned in alcohol and tobacco and pharma and other just traditional consumer products that want to be here and that will be here. So the fourth quarter to me is about the legacy players who are actually raising their game at a time when the ability for other folks to come into the industry and steal their thunder is part of that theme. So I expect we are going to see some evolution of a couple of the macro trends around legislation. In the last month, there has been talk about safe banking being essentially finding a way through the legislative path because there's a bill called the National Defense Authorization Act where this legislation can be slipped in. It's a piece of legislation that's going to move quickly, and there is support, bipartisan support, for safe banking, and safe banking at least to get this industry that is already been acknowledged on the federal level that we're going to let the states do what they need to do. There's an understanding in Washington that there's still some incongruity here when banks can't serve this industry, where big bags of money are being wheeled around, and that it's not safe for an industry to operate and to have this kind of inconsistent approach where the federal government acknowledges it's okay if the states vote for enactment and legislation. So I think we have macro headlines in the fourth quarter that actually you're going to see access to capital. You're going to see all the biggest investment banks in the world flood in here to help facilitate the capital markets and the growth of the industry, which will increase the valuations. But I do think you're going to get the type of headlines that the market started to sniff out in September. And if you look back on the charts, even in the third week of September, as this NDAA or safe banking connection and opportunity started to come to the surface, markets rallied pretty strong. We're going to get more of that.
Tim, let's wrap up with your current view on federal legalizations, the probability of it, and obviously the impact.
Yeah, so I think we just talked about that backdrop. So to extend on that, I think the reality that cannabis is fully, first of all, descheduled, which means that it's no longer a Schedule I drug, which means that not only would it not be something that would be available in an adult market or in a medical market. But there's a lot of issues for the companies that operate as long as it's Schedule I, and they include very punitive tax dynamics. If you're a Schedule I drug, by definition, there is no medical benefit for the drug. And we believe that cannabis and the efficacy around a number of different common medical uses, it's not even in question. So what will happen ultimately in a federally approved environment and a descheduling is that not only will companies be able to get access to capital and there'll be a much broader customer base, but some of the taxation on these companies will be very different. I think the expectation should be that Chuck Schumer and the small majority that the Democrats have in the Senate right now recognize in the last few months that all this excitement that we had after the Georgia runoff in January, where it seemed that the Democrats legislation and that was pushing through and get your full federal dynamic. I think that's been part of the disappointment of the summer, part of the disappointment of the third quarter, that Chuck Schumer's bill was too encompassing, too complex, too kitchen sink, throwing it all in there, and therefore dead on arrival. The excitement is that in the fourth quarter, the reality, you got to get something done. And that we have to, at least, if not in the fourth quarter, set the stage to get something done before midterm elections. That's what investors, I think, now are resigned to the fact. I think the market is priced in everything from the euphoria from February. Look, stocks reflect that disappointment. And at this point, don't think that they priced in a lot of excitement. But I do think that investors that have been in the middle of this industry for a couple of years do expect something. And I think you don't need a lot to see the market respond.
Tim, thanks for coming on for this update. To learn more about the CNBS ETF, please visit cnbsetf.com. That's cnbsetf.com. Thanks, Tim.
Thanks, Jay.